Decoding Business Health with Financial Ratios. We are thrilled to have you here as we explore the financial ratios that will serve as a powerful tool for evaluating companies' performance and guiding strategic decision. Now, the financial ratios are a key understanding to your organization for financial health. How to interpret the financial ratio is a insight to identify and address the overcoming financial weakness and understand how to take key decision when to invest. This we will understand going through this webinar. This webinar will offer practical insight on how ratios can guide us on proper practical decision making and show us the bigger picture along with the important tools, limitations, and important lesson. So today we have Ms. Ankita Sri Krishna Jawalkar, a expert in finance, financial analyst, and in corporate strategy. She is a learning facilitator. She has an immense experience in finance, and she will bring important insights uh, into interpreting financial ratios in real world scenario. So please welcome her. Also, I will be there helping her, supporting her. I am also a learning facilitator in UniAthena, specializing in management and finance education. Today we will be guiding you and give you a important session, facilitate a meaningful discussion in vital topics. So before we dive into the session, we kindly request all the participants, all the attendees to keep their microphone off or on mute to ensure smooth experience for everyone. We encourage to ask you question in the Q&A box so that we can address them at the end of the webinar. Before starting, we also like to inform you that we will be giving you certificates for participation uh, that will be for free at the end of the webinar uh, in your registered email ID. So without any further delay, let's begin and explore how financial ratio will help us to understand company's health and help the stakeholders to take important decisions. Ankita, can you move to the next slide? So initially, why we need the financial ratios, right? So first, we need to access the company's performance and health. So when we evaluate any company's performance, we need to go through the ratios like profitability ratio, or we go through the net profit ratios, liquidity ratios to check how much the company is actually performing in terms of their revenues, in terms of their expenses. Also, it helps the stakeholders to take informed decision. How much liquidity is there? How much uh, debt is there? Going through the ratios. There are various aspects of growth in investment and strategy. So going through the trends of the ratios of any companies, we can able to see that whether the company is performing well or whether the company is performing on average. So this gives us the picture when we go through the ratios. Now we have normally profitability ratios, liquidity ratio, solvency ratio. So going through each ratio, we will able to identify that how this ratio helps us to evaluate companies' performance and help us to take informed decision. Ankita, can you move to the next slide? Now, here are certain tools which will make us understand how to evaluate the financial statement. So first, we can consider the comparative statement analysis where we will evaluate the financial performance over multiple periods, and uh, and then we can check that how much asset is there, how much uh, uh, the revenue is there, what is the current scenario of the on the liabilities, and how much liquidity is there, so that it can able to understand, it can able to we can able to identify the near the liquidity for the near future. If we see the common size statement, we can also understand the financial item and we can compare it to a percentage. Now, going through percentage, it's become easier for the stakeholders to understand and to make informed decision. Trend analysis is another pattern where the stakeholders can able to check, were able to identify the pattern, the data, how the company is performing. If the company is performing like on average, so he can take a decision whether to invest or de-invest. If the performance is doing well, having a growth in the revenue, then then the stakeholders can take an informed decision and can invest in the company. So going through the trend, there are certain factors. Based on that, the stakeholders or any person can uh, do take decision. On the fourth, we will do this ratio analysis. We will be focusing on ratio analysis today. So if we compare the ratio analysis going through each ratios, like profitability ratio is there, we have solvency ratios, we have return on asset ratio. So going through each ratio, we can able to identify what does it interpret and what should be the ideal value, and based on the value we can able to understand that what need to be done to improve the performance of the company. And lastly, we have cash flow statement, where we can check, we can identify that how much cash is coming in this statement over the period and how much cash is going out over the period. This will give us the this will help us to see how much liquidity is there in the organization. Ankita, can you move to the next slide? And I hope Ankita will be taking over from this slide.
Yeah, well, thank you, Arga. Thank you so much for the wonderful introduction. And I'm sure all of our attendees have, got a very good idea on what kind of analysis takes place in a company when it comes to analyzing its profitability, its revenue, its performance over years. Now, dear attendees, as you have joined and we have just started, let me tell you, this is not a topic which needs an introduction. All of us, whether from finance or a non-finance background, are aware about this topic, and I personally feel that all of us need to know this sometime in their lives so that it gets easier for all of us to decode the financial health of any company. Okay, again, you might be questioning why financial health of a company. So sometime or the other in life we are about to encounter the financial statements, and we need to understand what we need to look into when it comes to a particular financial statement of a company. Now, as you can see on the screen, and as Arga has said, today we will look into the ratio analysis, and we will take you to some important ratios that are a part of a company's financial health, and will make you understand how they should look like and how they should be. So as we can see, there are the types of ratio analysis. We will start with the first one, which is the liquidity ratio. Now, basically, liquidity is something where a company is able to easily convert anything that they have into cash. Okay, so liquidity talks about conversion into cash all the time, and those two ratios that reflect liquidity in a particular company come from the are also called as the current ratio and a quick ratio. So current ratio, normally what is a current ratio and how you are supposed to calculate that, we look in the upcoming slides. And basically, a quick ratio gives you a small and an easier and a faster and a quicker way of looking at a company's health and how it is operating. So these are basically more inclined towards the operational part of the company and the operational activities, I would say. The second is the solvency ratio. So anytime you start a company or anytime you are into a company, looking at a company's health and looking for how long it will run, how long it is going to take for that company to grow, or will it close down, you always have to look at the solvency ratio. Is the company able to pay back its liabilities in long term? So when I say I am looking at paying off in long term, I'm looking at the solvency ratio. And the two ratios which are most important or a part of solvency ratios are is the debt is to equity ratio. We'll have a look at the debt is to equity in some time. And the second is interest coverage ratio. Now, all of us know that interest is an integral part of all of our liabilities, may it be a short term or a long term. So, are we able to cover up that particular liability considering the interest talks about the interest coverage ratio? Going ahead, we'll have a look at the most important ratio in a company, which is a profitability ratio. A profitability ratio in a company talks about how profitable the company is and how profitable it has been since it was established, and will it remain profitable for a longer period of time. Ultimately, every aim of the business, or all of the aims of the business, direct to profit at the end. So when I say profitability, I mean I'm calculating the a gross profit ratio, a net profit ratio, an operating profit ratio, or return on capital employed ratio. All of these ratios take us to the profitability and ultimately help us decide the profitability of the company. Now we'll have a look at the turnover ratio. Basically, the turnover is the volatility of the operations, the revenue, and the expenses taken together. So why do we need to know the volatility in a business? Is because we need to understand the flow. We need to understand the flow of expenses, the inflow and outflow. So these ratios are again in the form of a fixed asset turnover ratio, an inventory turnover ratio, or a receivables turnover ratio. So normally these ratios help us understand if we are able to cover up our receivables and payables taken together. The last are the market value ratios, and these ratios form as the final part of a company's financial performance while we are looking at the shareholding of the company, while we are looking at the capital of the company, the capital holding of the company. So is that particular? So as you can see, all in all ratios are giving a particular hint to us which say that what are the returns on whatever is invested. So basically ratios are a way to check on whatever is being invested in a company. Is it returnable, is it payable, and is it profitable in long run? So market value ratio, the last one, is the earnings per share ratio. Normally how every share is being paid back and how profitable every share of the company is. And return on net worth. Net worth is basically the capital invested in that particular company, the worth of the company, and is it worth having that particular net worth or holding it at that value for a longer period of time. So this is how our types of ratios look like. Once we dive into detailed discussion on the ratios, you will eventually start an understanding what to look at when it comes to ratios. Now, how ratios help in decision making? So basically, ratios help in informed decisions. Now, these decisions are essential and integral part once the balance sheets are out at the end of the year. Why are these decisions essential? Because the company has to make changes with respect to their capital investment, their share value, their dividend rates, their returns on assets. So all in all keeps on changing as and how the business starts performing better and starts getting better. So performance evaluation is one of the part which helps in understanding and building up good ratios in a company over a period of time and vice versa. Financial stability is arrived by way of ratios because you get to understand how well you are able to pay back your liabilities and how well you are able to invest. Benchmarking helps in setting up some specific standards for that particular company and marking it as per the industry standards as well. So keeping in line with what is happening with similar competitors with that particular industries helps in understanding the company's financial health. Risk assessment makes you ready for future risks that come up, that are posed, and keeps you highly liquid in case of risk situations, in case of situations where you need to hold excess amount of cash, excess amount of liquidity, where you have to keep yourself that stable that the risks when come up, you should be able to pay back your debts. Strategic planning helps in making and planning future strategies, understanding how business will perform in long run, achieving a long-term operational efficiency. When it comes to businesses, there is a chance that the operational efficiency has to be the highest, so that ultimately your balance sheet figures show the convincing figures that you want. Okay, so that is what operational efficiency talks about. Investment decisions making and trying to invest, breaking a investment and making an investment. Again, two main important things that ratios help in. So you should or you should not invest is an important and integral part of a business, helping you control all your costs and cover them up in long run. May it be a fixed cost, may it be a variable cost, may it be the costs that keep on changing and coming up in the business over a longer period of time, and trying to cover up those costs helps a particular business understand the ratios, and the ratios help in return understand the costs. Credit worthiness is understanding how well you are able to hold credit, buy credit, and pay it off in a longer run. And lastly, helps in a trend analysis. So as and how we go ahead in the presentation, we'll understand what trend analysis is. Okay, now these are the key ratios that we have got here for you, and we want you to understand. And these ratios, every time you are into management accounting, cost accounting, or financial accounting, you will always encounter these ratios in your life, and you need to understand how these ratios can be decoded. Okay, so first we'll have a look at the liquidity ratio. The liquidity ratio helps us measure a company's ability to meet short-term obligations, something that is less than 5 years of time frame where I have to pay it back in less than 5 years is my short-term obligation. So when I have to arrive at a short-term obligation in terms of current ratio, in terms of the assets and current assets and liabilities, I use the current ratio. So the current ratio is normally current assets is to current liabilities. Now coming to the quick ratio, the quick ratio helps understand or assess liquidity, including the inventory, because in a business, the inventory flow has to be continuous, has to be stable, and has to be in line with the operations that are going on in my business. So quick ratio is current assets minus inventory upon current liabilities. So basically this ratio will eradicate the inventory because there is high amount of volatility in inventory, and then it will talk about the fast and the quick plan, the quickest situation, that quickest position of my business. Now going ahead, we'll have a look at the profitability ratio. So profitability ratio measures the company's ability to generate profits efficiently. The word efficiently is very important here, because any business and every business can be profitable, but profitability ratio is the ratio which helps you understand the efficiency in generating profit. So gross profit margin is the first ratio and or one of the ratios in profitability. So gross profit ratio uses gross profit and the total revenue multiplied by 100. This is in percentage, and it's help you understand what is the percentage of gross profit generation. Whereas net profit generation uses net profit divided by revenue into 100. So it helps you understand your net profit. Gross is basically are the figures in the profit before the calculation of all the taxation and interest rates, whereas net profit is the final profit figure once you deduct all your interest and profits and depreciation. Going ahead, the profitability ratio. Now, next set of profitability ratios are the ones which talk about profitability in terms of the assets that are being held by a company. So again, measures the company's ability to generate profits efficiently, but in terms of what? In terms of assets. So we'll see a return on assets. Now, why do I calculate return on asset? So basically, why assets are being held is because they are and meant to be profitable in business for a longer period of time. So I every time want to hold an asset and use it as long as I wish to get maximum benefit out of it. Okay, and also provide depreciation. So as and how the asset starts depreciating, it will start giving you lesser and lesser returns. So this is what I do. I try to calculate return on assets for a longer period of time. So company's efficiency in using its assets to generate profit. So return on assets, which is ROA, is equal to net income on total divided by total assets into 100. So basically return on assets is calculated with this particular ratio. Now coming to return on equity, equity is the equity capital, the investment capital that is done in a particular business, and I need to check for the invested capital to be returnable or not, again in long term, because it is being held in business for a longish period of time. So return on equity is equal to net income on shareholders interest multiplied by 100. So these are basically in the form of percentages which help you understand that particular business, which help you understand and decode that particular business being better off or worse off in long run. Then we come to the efficiency ratios. Again, being efficient, being profitable, being liquidable, and being solvent are all different set of terminologies, and also are those important terminologies which help a business decode, the external and internal environment. So looking at the efficiency ratio, we have accounts payable turnover ratio. So basically payables are the ones which I'm supposed to pay to the people, to the clients, to my customers, to people who are to whom the cash has gone out from business. So accounts payable measures how quickly a company pays off its suppliers. So it is cost of goods sold, how much cost of goods I'm having divided by the average accounts payable. So normally in how much time frame, and normally it also is calculated in terms of the 365 days in a year, how well I am able to pay, what is the frequency, the cycle of payables that I maintain over a period of time. This cycle is efficiently decided by an accounts payable ratio, whereas accounts receivable ratio measures how efficiently a company collects its receivables. So I have to also collect money and I also have to pay back. So collection period is the net credit sales on the average divided by the average accounts receivable. So how well people are paying me back? Are they paying in cycles? Are they paying in months? Are they paying in every 6 months? And I have to set a particular pace to this because I'm doing a business. I have to be assured about my payables and receivables in long run. That is the reason we check the efficiency of a particular company in terms of efficiency ratio. Yes, Aga, you can take up from here.
Yes, yes. Thank you. So, thank you, Ankita, for giving us the insight on the other ratios. So, solvency ratio is again, it's how a company is able to meet the long-term obligation. It's like uh, the liquidity ratio, where it's normally assess the short-term ratio obligations. But here, how the company is able to meet the long-term obligations. Here we will understand the solvency ratios. Now, first is the debt to equity ratio, where the company will able to understand, where the company will able to measure the financial leverage over the long term solvency. So if so the formula is the total debt by shareholders equity. So if the total debt by is higher, if the debt to equity is higher, so the risk of the financial risk is considered to be higher. So it should be below or equal to 1. If it is more than 1, so there is a chance the obligation, the financial long-term obligation risk is tends to be higher. The second is the interest coverage ratio, where the company able to pay the interest on its debt. If the again, if the value is low, then it's fine. Then the company is able to give the interest based on the debt. But if the value is again higher, there is a chance there is a chance of financial risk for the future. So based on the value, it is considered, if the value is lesser, the financial risk is low. If the value is higher, there is a higher chance the company may seems to have a higher financial risk in the future. Can you go to the next slide? Yeah. So here, Ankita, you can take over if you.
Yeah, thank you, Arga. Now, as you can see on the screen, we have a question for you. Okay, so we would like you to answer Which type of financial ratio do you find most important for evaluating a company's financial health? So the first option is liquidity, the second is profitability, the third is efficiency, and the fourth is solvency. So you can put your answers in the chat box and we'll have a look at your answers. So the question says, which type of financial ratio do you find the most important for evaluating a company's financial health? We would
Joshua
like to
said
know.
it's liquidity ratio.
Yeah, there
Benign
are answers
said,
coming in.
yeah, Benign said it's efficiency ratio. Stephen said it's again if liquidity ratio.
So we have Joshua
Yeah,
also saying the first
yeah.
one, liquidity and profitability. So now
And
on, if you see a financial statement, I'm sure you know where to look at and where you want to decide, how you want to decide about a company's financial performance. Thank you, everyone. Thank you for your answers. So basically, we have got one and two. I guess one and two is the correct answer. The first
yes.
preferred answer, I would say. There is no right or wrong because what I would say is
Hmm.
what you have to look at most is the profitability and the liquidity of a company. Now, here we have an example for you, and we will be solving that example. And we normally have pulled this particular balance sheet items from an example, and we will like to understand and we'll like to calculate the ratio here now. Now, as you can see on the screen, ABC Manufacturing produces electronic components and has been in business for 5 years. In the last financial report, the management team wants to assess the company's financial health and performance using various financial ratios. Now, we will be calculating some ratios in the upcoming slides. So, I just want you to have a look and I want you to note down some important items you feel will be useful in the upcoming slides for calculating the ratios. So, I'll just give you 2 minutes of time. And once you take a note of the important items, we will go ahead and we will calculate the ratios. So Arga, what is the first ratio that we are going to calculate now? And what are the items that I will require?
So first is the debt to equity ratio, right? So total debt is, I guess, 1,20,000 and shares equity is 80,000. So if you see, we can notice that it's 1.5% and it is like it is like for every $1 of equity, the debt is 1.5. So
Yeah.
as I said, if the value is higher, so there is a chance of higher financial risk. So it is suggested or to lower down the debt so that the risk, the financial risk tends to get lower and there is a higher chance to get more revenue rather than more debt. And it will help the company to grow.
Yeah, Arga, now I remember here the industry benchmark for debt is to equity is 2 is to 1.
Hmm.
And as our company example says that the ratio which company has is 1.5 is to 1. So which means the company hasn't reached the industry benchmark
Hmm.
yet and is in a position of a higher financial risk. So normally there might be chance in long run that the company is not able to pay off its debt compared to the equity.
Hmm.
Now we'll go ahead and have a look at the next ratio. So the next ratio is the inventory turnover ratio. So basically here I'm using two main important items from that particular balance sheet or that particular balance sheet items which I have, and those are cost of goods sold on average inventory. So basically average inventory is the opening and the closing inventory. It's the average of that inventory that I take up. And why do I take average inventory? Is because I have to understand, considering both the items, both opening and closing inventory. So the cost of goods sold is somewhere around 18,
Hmm.
and my average inventory is 1,50,000. So when 18 is to 1,50,000 is calculated, it gives me 12.0. So basically, the interpretation says an inventory turnover ratio of 12 means the company sells and replaces its inventory 12 times in a year,
Hmm.
indicating efficient inventory management. So the number of times the inventory is replaced is calculated with this ratio. And if it is more, even then that could be issue. If it is less, even then that could be an issue.
So basically, there are no stocks in the warehouse.
Yes, yes.
It is
So the
getting
inventory
replaced.
turnover has to be so stable that it goes in line with my operations. It goes in line with my sales and revenue.
Yes.
Now we have something called as trend analysis. So we saw an easier example where we could easily track down ratios and pick specific items from balance sheet, put them into the ratio formula and just arrive at ratios. So it's as simple as that, as in how you start getting into management accounting and financial accounting. You'll be very well versed with these particular ratio calculations. Now, there is something called as trend analysis, and trend analysis in itself says that there is a trend over a longer period of time which has to be analyzed. Now, why do I have to analyze a trend in a business? Is because I need to understand how my business will be, how my business has been, and how my business is currently profitable. Is it going good or bad? So this is how I calculate. This is what I calculate when it comes to trend analysis, and it happens over a period of time by looking at the ratios over a period of time. So let's suppose I'm looking at ratios 5 years before and I'm looking at ratios post 5 years. Okay, so the first step in a trend analysis is historical data collection. Let's suppose I want to look at a business back 20 years back. So I'll have to go back 20 years back into the financial statements and look at the data previously, how the business was 20 years back and how it will be or is and will be in the coming years. The second step is the key ratio calculation. I pick specific items I want to look at in trend analysis. Let's suppose I'm looking at the solvency of that particular company 20 years back, and today I want to check if the solvency has improved after 20 years. So that is what I try to, I'll pick specific items in solvency ratio and calculate it considering the current data that I have. The third one is data organization, putting data into specific place in order to get further ratios, in order to check for the feasibility and make changes in current resources. The fourth is trend identification, identifying trend. Earlier, the company was very solvent, then it was moderately solvent, and now it is highly solvent. So this is what we are trying to understand in terms of trend identification. And lastly, we have informed decision making. So lastly, I'll try to decide and check for the solvency in my company. If anything has to be improved, I'll try to improve that in the future years. So again, Arga, I think we have an
Hmm.
example here. If
Yeah.
you want to,
Yeah. So as we can see, there is a scenario of ABC manufacturing company showing the data of 3 years, right? Now the net income is provided like for 400,000, and the revenue they generated 2,500, uh, yeah, 2,50,000. Total asset is also there, total debt is there, shareholder equity is there, and the average inventory, COGS, everything is there. So from this data, we can able easily calculate the average, the net profit ratio, then ROA, inventory turnover, and the debt equity ratio. Now, this is the calculation for only the first year. Like that, we need to calculate the next two consecutive year. So if we see the net profit margin is 16% on 2021. If we see 2022 and 2023's data, it's increased. like 16 to 16.67. So they are having a good profit margin over the years. Same goes with the return on asset. It was initially 22.22%, but in 2022 and in 2023, they have significantly increased on the return on asset. It was 2023.68 to 20 and 25 on 2023. So based on this trend, we can able to identify that the company ABC Manufacturing, they are doing very well, and they have also having very good debt equity ratio, and they have having good inventory turnover ratio. So based on the scenario, we can able to identify the trend that the company is actually performing well. They are having good amount of revenues generated, good amount of return on asset. The turnover of inventory is also very good. But however, in the debt equity ratio, it is bit higher, which can be reduced based on the profit they are generating.
So, Arga, I could see their inventory turnover was better in 2021, but then they
Hmm.
fell and then it started reducing.
Then
Okay. So
again,
if there is
they have
higher
increased
turnover and then there is less turnover.
less turnover.
Whereas return on assets was less before, but then they started getting a better return on assets over a
Mm-hmm.
period of time.
Over
So
the
as you
period.
can see, this kind of trend analysis is being conducted for 3 years. So every time there is a trend analysis, I take data from past years, this particular year, and if I want a trend analysis in the next year itself, I'll restore this data. I'll try to check for all the ratios and try to make my decisions more informed and better. Now, going ahead, I'm looking at interpreting the trends in that particular the example that we have taken. So net profit margin. So basically in that particular example, as you can see, the net profit margin, it talks about 16, 6.7 and 6.67. So
It's stable
basically
actually.
stable, indicating a consistent profitability over a period of time. Return on assets shows an increasing trend, efficient in generating profits, and they are able to cover up the costs of assets. Also, they are trying to get maximum out of the assets. They are trying to get more returns on assets over a period of time. Decline in inventory turnover ratio indicates a possible buildup of inventory. So as I said, Arga, there was 13, 12, and 12. So again,
12.
the inventory is not selling
Mm.
faster. That is why there is a possible chance of inventory buildup, and that is why the inventory turnover ratio has dropped down.
Drop down.
And debt is to equity, an increasing ratio relying more on debt financing relative to equity. So there is a higher financial risk. So basically, they have relied more on debt, and debt has
Debt.
also increased over
Correct.
time, Arga. I could
Over
see
time.
earlier, yeah, it was 10 lakhs and then it was 11 and then it was 12. So dependence on debt also has increased. That is why there is a
High
higher,
chance financial
there
risk.
are higher financial risk of not being paid off in
Mm.
longer run. Now, making informed decisions. So, what I have to look into for that particular example and what I can change in that particular example for making informed decisions. So, I can focus on making it more efficient because the inventory turnover ratio dropped down. I can improve inventory management and try to sell more, manage my debt levels, try to control the intake of debt, and try to reduce the figures, reduce more reliance on debt, again not rely more on debt, try to save more, and try to circulate my capital inside the business more. Improving cash flow management, trying to increase the cash flow in my business, trying to get more out of cash. Investment and growth, trying to grow more in terms of longer run and reinvesting my profits back. So then the reliance on debt will reduce and I'll start reinvesting in my profit more. Now, looking at the limitations of ratio analysis, okay, so we have specific limitations on ratio analysis. And at times it does happen that while we are calculating ratios, we face some limitations. Why have we put this up here is because we want to discuss the limitations while we are also looking at the benefits, and we want you to also know where to make adjustments and where not to look at. So limitations of ratio analysis is lack of context. At times it does happen. The data from the past years is redundant. The data from past years it quite is quite at times that inefficient. So in those cases there is lack of context. Arga, rest three if you can take.
Yeah, yeah. So then we have a static snapshot. Like sometimes what happens, the data that the company shows, sometimes what happened, they are not being updated on the later year. So what happens? There is a lack of validation in the data. So at that point, the ratio analysis tends to be not proper for the stakeholders. So based on that, the static snapshot is not applicable for ratio analysis. Same goes with the quality of data. Uh, since the data is not reliable, the evaluation from the ratio analysis sometimes do not give a proper picture for the stakeholders, for the end users, for the compliance holder, everyone. So looking at that also, the quality of the data has to be maintained, because sometimes there is some legality issues, there is some compliance issue, due to which this quality of data may seems to be harmful for the company. And there are other non-financial factor, as we have gone through the ratio analysis. What we have noticed that the trends uh, that we have seen, we cannot able to identify the trends. We cannot able to just see what is the inventory that the company is actually having. We cannot able to understand what is the revenue that the company is actually showing us. So certain financial factor, certain non-financial factor, they are also proper, has to be just properly shown throughout the years. Can you go to the next slide?
Now, looking at the limitations of ratio analysis, furthermore, we have some more limitations. So there is a short-term focus here. Basically, when ratios come into play and when I have to calculate ratios, it's just only for a brief period of time that particular year, that particular financial year. And at times it might happen that once I make huge amount of changes in my business, so these changes in the business tend to make the ratios fluctuate over a longish period of time and then change them altogether, change them flip, okay, or see the you can see the ratios flip altogether. So this is a short term focus. There is manipulation risk. A huge amount of manipulation risks happen in a business because manipulation risks are something every business has to stay away from, and not those are particular mindsets at that particular point of time, and they tend to divert you from that particular business decision making, I feel. The third is sector variability. Rightfully, I could argue basically there is a very good and relative comment from one of the learners who has talked about
Hmm.
sector variability, and I could see that he already has talked about this particular sector variability. So that is very important part because it depends on different sectors of business, which business you are entirely into, and there are huge changes in business depending upon the operations that the business conducts. So there is sector variability. You cannot say that this business should operate this and so only, or should have
So
this
true, so
ratio.
true.
So
Because
this is
if we consider the inventory, if a business is depending on inventory, and if the inventory turnover ratio is higher, let's say, so it's actually good for the business sector. So it's depend on the business sectors, and if a business is do not have a inventory based business, so at that time inventory turnover may not comes into place. So
yeah.
sector variability actually one of the limitation that
And
ratio analysis have.
thank you, Najam. Thank you, Najamul Hassan, for pointing this out. And we really liked the way you are, taking this webinar, and you have actually pointed out the right point. Lastly, we'll talk about the last limitation, which is on overemphasis of
Hmm.
numbers. Yes, it does happen, I think, Arga, because
Yes.
we are looking at specific numbers at one time, and after a longer period of time, the numbers tend to change. There are not there is no specific outcome at times, and the specific outcomes tends to change also after a longer period of time. So I think over emphasis on numbers is also one of the limitations.
Hmm.
Now, common adjustments to ratios. Now, after calculating ratios, taking the figures from financial statements, there are some common adjustments that every business or businesses tend to make, and we'll have a look at them. So, normalization, normally, if there are huge number differences, that are fine. But then, when there is a very low number difference and the company is assured that they'll overcome the difference, then normalization is taken into consideration. Seasonal adjustments, yes, few businesses are seasonal in nature and the ratios also tend to go high or low. So again, there are seasonal adjustments taken into consideration. Pro forma adjustments. At times, the company wants to maintain a particular ratio for a longer period of time, irrespective of performance, and these are the pro forma adjustments. Debt adjustments are basically trying to overcome debts, but debt adjustments are done as per the priority of paying debt. So at times, a company might be showing higher amount of debt repayment, but would not want to repay that debt for a longer period of time or want to prioritize it later. So basically, priorities change, as you can see. Equity adjustments, again, equity adjustments come with how much capital is required, how much capital is invested. Is there a need of capital in future? Inflation adjustments are also made because there are price rise changes. So at times there are changes with respect to the business performances also. We have specific industry specific metrics. At times other businesses, competitors, or industry metrics show that this particular format of ratio has been profitable in long run, and that help us ascertain the industry specific ratio. Cash flow adjustments. Normally, cash flow adjustments are made in order to keep liquidity, in order to hold cash for a longer period of time. Cash and convertibles are considered in order to check for the cash flow adjustments. Then we have tax adjustments because there are chances that business tend to pay higher or less amount of tax depending upon the policy set by the government, and that is entirely a part of the external environment of a business. So tax adjustments are there. And lastly, you have comparative analysis. So at times, for a comparative analysis and for keeping or checking the position of the business when it was better off earlier and trying to be in the same position today, is a part of the comparative analysis of that particular business. So these are the basic common adjustments that we make to ratio analysis. Yes, Arga, you can go ahead.
Yes. So there are certain tools that can be used in ratio analysis. First, as I have discussed, that we can go through the financial statements and we can able to analyze the revenue, the inventory, uh, their losses, their everything. So based going through the financial statement from the profit and loss statement is there, the balance sheet, we can able to understand how to generate the ratios, right? So going through the financial statement, we can able to easily get the ratio analysis. Also, we have ratios. We can also go through actual ratios from the companies where we can able to see the check the ratios and justify what we can interpret what actually is there. Then we have the benchmarking. Benchmarking is basically when we actually compare the performance of the company with the competitors, with the industry leaders, and based on that we can able to uh, check what need to be done so that it can be improved, and we can or the company can perform better in the future. Trend analysis, as we have already discussed, that over the past years, uh, we can able to identify that how the company is performed, and based on that we can able to invest or de-invest, or we can check that we can actually check the things, and we can make certain improvement on the company's financial performance. Graphical representation is also there. Is one of the easier tool to check the performance of the company. There are spreadsheet software like we can go through Excel is there, and from Excel we can just easily put the formulas and we can get the actual values, and based on that, as we have already discussed, we can interpret the values and just able to understand where the company actual stand. Financial analysis software is there. We have many software, ERP softwares are there. So if we just simply click on ratio analysis, all the things will be generated. But as we have discussed, in the limitations that we need to actually go through the financial statement, check the values, and then we can easily able to put the values to generate the ratios. And then we have standardized form. We can simply use the ratios from the financial statement and generate the ratios. And based on that, we can able to identify what is expected from the company, how the company will perform in the future, and then easily we can derive what need to be done so that the company can improve their financial performance. Uh, yes, Ankita. Yeah.
Yeah, so now we have some questions for you. Okay. We would want you to answer them in the chat box. Okay. So we'll discuss them one by one. And meanwhile, if you have any other questions, you can shoot your questions in the chat box. We will be answering them at the end of the session. So we have a question for you the case talks about a liquidity crisis. So XYZ Incorporation has a current ratio and a quick ratio below 1. So I'll give you a hint here. You have to consider the industry benchmark. Indicating a liquidity crunch, what would be the best initial approach to address this issue? So please put your answers in the chat box. Increase inventory, boost, sell non-essential assets, take on additional long-term debt and offer long credit terms. So this question can be answered in the chat box. So you can answer this particular question.
Number third, Alan has already settled. Number three,
Yeah, so you can answer this. Samir is saying second choice.
Samir said second choice. Sell non-essential asset to cash ratio. To his cash, okay. Second and third. Mostly the answers are from second and third.
Zuha has also answered. He's saying second, sell non-essential
Hmm.
assets to raise cash.
Steven said first option, increase the inventory to boost current asset. Mostly the answers are either second or third.
So yeah, basically increasing liquidity is increasing the
Hmm.
cash holdings. So I would say second option, selling on essential assets, non-essential assets to increase cash flow. Going ahead, we have second question for you on profitability decline. So ABC Retail is experiencing declining profitability despite increasing sales.
Hmm.
So there is declining profitability, but there is sales increase. What would be a primary reason for this? So reduced operational costs and increase in cost of goods sold related to sales, reduction in tax liabilities, and increased returns and allowances, reducing revenue. So the question has changed. The question is regarding the profitability decline.
First, second.
We are getting responses for this as well.
Last option, Iman said. Increased return and allowance, reducing revenue.
An increase in cost of goods sold related to sales. Going ahead, we have third question for you. High debt load. So DF Corporation has high debt to equity ratio posing financial risk. What might be an effective approach to managing this particular risk? High debt is to equity ratio. What might be an effective approach? So it is increasing dividends, defer debt payments to focus on operational expansion, refinance existing debt to lower interest rate, use retained earnings to fund more debt acquisitions. So yeah, the question has changed again. It talks about high debt load. I'll just try to reduce the debt load which I have.
Third option.
Yeah, refinance existing debt and use more of my retained earnings to reduce the debt. But then again, getting more debt is again falling into the debt trap. So trying to reduce debt. And now we have the last question for today would be inventory management issue. So GHI wholesale has low inventory turnover, suggesting slow moving inventory. What would be the suitable solution? I want to make my inventory flow faster. So what would be the issue? What would be the suitable solution? Increase prices to improve profit margins, reduce purchase orders,
Second, everyone is saying second.
extend
Only
credit
Samir.
terms to encourage invest in additional warehousing.
Hmm.
Okay, so we are getting answers for second and third. So here we go, Arga. Going ahead. Attendees,
Yes.
please
So
feel free to shoot your Q&A in the chat box. We'll take that in some time. Arga, you can go ahead.
okay. So thank you once again for joining us in this webinar. Everyone has a very good feedback, and we really appreciate that. So at the we will be answering some questions at the end of the webinar. You can post your questions here. So now we are at the end. So thank you once again, and we will be giving you a brief overview on UniAthena. So basically, UniAthena is an edtech platform where all MBAs, master, and doctorate courses are provided. It's a self-paced and flexible education program, and it has over 3 million global upskillers who are actually using UniAthena for their education. Can you go to the next slide? So if you want to look into a career for financial management, you can check out the courses, the MBA courses that UniAthena provide. So UniAthena is actually, as I told you, that it's an edtech organization. It's offered online courses, affordable academic courses in flexible manner. It was founded in 2029. It's actually owned by Westward Venture, which is known as Westward Education Group. It has been operating since 2028. Can you move to the next slide? So we have partners and accreditations from these universities. We have Abate University, we have Unimarconi University, we have UCAM, CIQ University, CMI University is there, SQA is there. We have FEDE University, EI European Business School is there, and lastly we have Acacia University, who are partners with UniAthena. Now, we makes education affordable and accessible, so it's very much free to learn if you go through the short courses, and if you go through the higher education courses, it's very affordable if comparing with the other online course platform. Now we have the learning model. We provide online delivery through video lectures, and the reading materials are also online. The learner can study at their own pace, at their own time. The delivery of each lectures is very short, very crisp. It's 15 to 20 minutes. And the payments are also very flexible. So based on the payment is as per the progression of each module. Now we have the disciplines. As you can see, we have marketing. This is there, finance is there, data science is there, engineering management, project management, construction management, human resource, business law, blockchain, artificial intelligence, international business, supply chain management, operation management, strategic management, and leadership development. So these disciplines are a part of UniAthena. You can individually check them out and participate and enroll for the courses. And go to the next. Yeah. So our popular offering is global MBA, uh, mm, then MBA in general management, master in supply chain and logistics management, MBA in business intelligence and data analytics. We have doctorate also, doctorate of the business administration, MBA in project operation and project management, and we have also courses in data science, master in data science. You can be also enrolled in these courses. So if you go through the testimonials, you can go through their feedback, and based on that, you can see how genuine the feedbacks are and how they have done well in their career going through these courses. So we can take the Q&A, Ankita, if you say, or
Before
we
that,
can.
Arga, we have a special person here who is our student ambassador, and he would like to share his experience with us. So, Kamara, if
Sure,
you are
sure,
with
sure.
us, you can
Kamara,
speak.
Kamara, we can. You need to enable Kamara.
He has
Okay,
been enabled. So,
okay, okay.
Kamara, can you
Kamara,
hear us?
you can unmute. Kamara, you can speak now. We have given you the option.
Hello, everyone. Good morning, good afternoon, and good evening, wherever you find
Kamara,
yourself.
if you can enable the camera, if possible.
I'm trying,
Oh, not a problem, no problem. If it is not enabling, no problem. You can.
I hope my voice is going out.
It's clear. It's
Yes.
clear.
All right. Hello, everyone. I'm Mohamed Kamara from Sierra Leone, the brand ambassador for UniAthena. It is a great opportunity and a great platform for us in this region for us to have the main concepts about this about the main global learning. It is a safe space learning wherein from work I come home, I log into the page, then have a class. That's a great and a wonderful time for me to have because it's a self-paced learning. So I think that's the most important way of majority of the individual now in the world are looking for having time, self-space time, wherein you have your time routine and this is a great place wherein everyone is boast of UniAthena. UniAthena is a great platform and it's a great place for us to skill up our learning, for us to be up there in terms of learning of having the high skills in terms of your main career and the education as well. We say thanks to the team and for such a great opportunity for spreading its global wings to us. Thank you, Tina, and thank you, everyone.
Thank you, Kamara, for sharing your wonderful experience with us. Arga, I'll just take down the Q&A, okay?
Okay, okay. All
Thank you,
yours.
attendees, for shooting your questions in the chat box. We'll answer the important ones and the most relevant ones, okay? So there are some questions which are saying that will there be a certificate? Yes, you get a free certificate for this particular webinar. I had also put up a question which says if you like the webinar, and I could see many yes. So yeah, please do let us know if you like any of any of our slides, how you like the webinar, and what would you like to hear from us. We are always there to hear you out. Then Najamul Hassan says it is going on great. Thanks for such webinars. Thank you, Najam. Going ahead, this is an enlightening webinar. Thank you so much. Thank you, Andrew. It is a very interesting topic. Thank you, Andrew. Thank you so much. There is Maria saying all are important, but efficiency tells about its working and solvency for long run. Yeah, Maria, you're correct. So efficiency and solvency are important in longer run. There is a question which the learner, the particular attendee has been asking, saying that will you be sharing the slides? So let me tell you, you can watch this webinar anytime. We will not provide you a different PowerPoint slide, but you can watch this webinar anytime on YouTube. And it's already recorded on YouTube right now. If it's live, then it's going on live there. So you can watch it later on YouTube. It's an excellent webinar and eye opener. Thank you, Manuel. Thank you for that compliment. Yeah, so this was it for today. Thank you, everyone. Thank you for joining us. And meantime, if you have any queries, you can, or if you want to check or explore our courses, you can visit our website, UniAthena.com, or you can write to admissions@UniAthena for further information on enrolling into any course. So thank you for joining us today. Have a very good day and bye-bye. Take care of yourselves. Have a happy weekend.